Elections are an integral reality of a democracy. In a democratic government, you experience regular election at regular intervals. Elections take place. So the effects of elections and political events on the stock market trend is the topic of this video. The effects of elections as well as some political events on the stock markets, on stock market trends. So I want to look at item number 1 here, market uncertainty and volatility. Market uncertainty and volatility. So when it comes to uncertainty, you will discover that elections introduce uncertainty as investors are unsure about the outcome and, of course, the policies that we follow. What will be the outcome? Nobody knows. What policy will follow? Nobody knows. So there's that particular suspense, And not only that, this uncertainty can lead to market volatility, with investors reacting to speculations, to polls results, and changing political landscape. So all these factors will come in to influence how investors would react. You equally have, apart from the uncertainty, you have policy expectations. And when we talk about policy expectations, different political parties or candidates may propose, divergent economic policies. If the Democrat comes in, this is what they will do. If Republicans come in, this is what we expect. So different political parties, depending on your country, will then come in with different policies. And so investors may buy or sell stocks based on their expectations of the winner's policies on areas like taxes, regulations, and trade, which can lead to market swings during election periods. So it's a period where you experience fluctuations, volatility because of that uncertainty and expectation, that as it relates to the election and even the outcome of the election. Number 2 is impact of election outcomes on sector performance. Impact of election outcomes on sector performance. I want to consider factors like pro-industry policies. Pro-industry policies. So if a candidate is expected to implement favorable policies for certain sectors like infrastructure, like healthcare, like energy, so stocks in these sectors may experience a kind of, may experience a rally because of the future expected gains in the industry or in the company's concern. For example, a candidate advocating for increased infrastructure spending may boost construction and material stocks. Even the candidate emphasizes, infrastructural development. So you discover that companies that produce materials for construction like cement will then experience a boost. We as well have anti-business or regulatory policy. Anti-business or regulatory policies. On the other hand, if a candidate, promises stricter regulation, higher corporate taxes, or other policies perceived as harmful to business, then, stocks in the affected sector may fall. So tech companies, for example, may underperform if a candidate promises tighter regulations on data privacy and antitrust enforcement. So whichever policy comes out, it will affect one sector or the other. Number 3 is short-term market reaction. Short-term market reaction. So in this case, you have pre-election speculation. before the election actually takes place, you have speculation. People are bound to speculate, and so in the run up to election, markets may fluctuate based on speculation and polling data. The investors may adjust their portfolios to hedge against perceived risk, contributing to short-term market movements. They will tend to adjust their portfolio because of the risk expectation. There's election day volatility. Apart from the pre-election speculation, there's election day volatility. The uncertainty surrounding election, surrounding the actual election day, can cause increased volatility as investors react to exit polls and early results, and corresponding news reports. So markets often see sharp movements as as results come in, and the market anticipate potential outcomes. It's like when Trump was elected. Shares in the price of Tesla, experience a kind of there was that particular growth in the share price of Tesla, and probably other companies equally had a similar effect, experienced a similar impact. Number 4 is long-term effects of election outcome. Long-term effect of election outcome. After the pre-election speculation and after the actual result coming out, then we now look at the long-term effects of the election outcome. So in this regards, you consider economic policy shift. Economic policy shift. Often, an election, after the actual election, the newly elected government can implement new policies that affect taxes, trade, healthcare, and other areas. These shifts can have a long-term effect on market performance. For example, a new administration may change interest rate, tax rate, or corporate policies, which can influence investor sentiment and stock valuation for months or even years. By the time government bringing changes here and there, tax policy, corporate policies, and other policies of that nature, you discover that it will affect the markets for years to come. So you have investor confidence. If a government is seen as stable and are able to implement policies effectively, it can boost investor confidence, leading to market gains, leading to a spike in stock price. So conversely, political gridlock or uncertainty about the effectiveness of the new government may lower investor confidence, leading to a negative market sentiment. Whichever policy, whichever expectation, whichever anticipation, will certainly affect the markets for a long time. Number 5 is a market reaction based on political ideology. Market reaction based on political ideology. Please like this video and don't forget to subscribe to this channel. So under market reaction based on political ideology, you have conservative versus liberal policies. You have the conservative and you have the liberals. So their policies will certainly affect how the market reacts. So in some cases, market may favor one political ideology over another. For instance, market may respond positively to conservative economic policies that promote tax cuts, deregulations, and business friendly environments. Liberal policy focuses on social spending, increased regulations, and or high taxes may lead to concern among investors potentially causing a market downturn. So if a given policy causes concern, then investors should become like they will want to sell off their positions because of uncertainty and negative sentiment, and that will cause the market to take a downward dive. You as well have market history and past reaction, market history and past reaction. So historically, markets have sometimes shown a preference for continuity and stability, favoring incumbents and or political leaders perceived as business friendly. If a leader is perceived to be business friendly, then of course the market will react appropriately. However, these reactions can vary greatly depending on the context of the election and the candidate's platform. All these matters are worth considering. The candidate's platform as well as the context of the election. Number 6 is global influence. Global influence. So in this case, we are considering international reactions. How do other countries react to election results in your home country? Political events in one country can also influence global markets. For example, a U.S. presidential election may impact foreign markets if it affects global trades. If it affects global trade policies, if it affects tariffs, it would of course, elicit a kind of international reaction. So political uncertainty, in large economies like the US, China, or the EU can lead to global market fluctuation. In all these big countries. So whatever happens in those countries politically will certainly have effects in other countries across the world. When those countries sneeze, other countries will catch the cold. So this is how political events and elections affect they affect trends in the stock markets